Something breaks the same way every time. The market crashes, banks shudder, factories close, unemployment spikes, and everyone acts shocked. Politicians promise reforms, economists debate causes, the media blames whoever is in power. But if you look beneath the surface, beneath the partisan theatre and the technical jargon, you find something unsettling. The same 7 triggers appear before every major American economic collapse. Not similar triggers. The exact same structural fractures in the same sequence, creating the same result: the Panic of 1873, the crash of 1929, the stagflation crisis of the 1970s, the 2008 financial collapse. Different eras, different technologies, different political parties in charge. But the same 7 warning signs, flashing red, ignored until it was too late. These aren't theories, they're patterns, documented, measurable, repeating, across 150 years of American economic history. And once you see them, you can't unsee them. You start recognizing the triggers in real time, watching them activate one by one, knowing what comes next. Let me show you the 7 hidden triggers that precede every major collapse and why the system never learns to avoid them. The first trigger is always the same. Credit expands beyond the productive capacity of the real economy. Money floods into the system, not because there are more goods to buy or more factories to build, but because the financial system itself has loosened the constraints on lending. This happens every time. Before 1873, it was railroad bonds. Investors across America and Europe poured money into railroad companies. Thousands of miles of track were planned, financed, built. The problem was simple. Many of these railroads served areas with almost no population. They couldn't generate revenue. They couldn't cover costs. But the bonds kept selling because credit was easy and everyone believed railroads were the future. By 1873, over 35,000 miles of track had been laid in just 3 years. The economy couldn't absorb it. There weren't enough passengers, weren't enough freight customers. The railroads defaulted, the bonds collapsed, and the entire financial system, which had been built on the assumption that railroad debt was safe, came apart. Banks that held railroad bonds failed. Investment houses that underwrote the bonds failed, and the economy entered a depression that lasted 6 years. Before 1929, it was margin lending. Brokers allowed investors to buy stocks with just 10% down, borrowing the other 90%. This meant that for every dollar an investor had, they could control $10 worth of stock. When prices went up, returns were spectacular. But the credit wasn't backed by real value. It was backed by the assumption that stock prices would keep rising. By the summer of 1929, margin debt had reached levels never seen before. Ordinary people, school teachers, clerks, factory workers, were borrowing to buy stocks they didn't understand in companies whose earnings didn't justify the prices. The credit expansion had disconnected from reality, and when prices started falling in October, the margin calls came. Investors had to sell to cover their loans. Selling pushed prices lower. Lower prices triggered more margin calls, more selling. The cycle fed itself. Within weeks, the market lost nearly half its value. Banks that had lent on margin failed. Brokerage houses collapsed, and the economy fell into the Great Depression. Before 2008, it was mortgage lending. Banks and shadow banks originated loans to borrowers who couldn't afford them, packaged those loans into securities, sold the securities to investors, and used the proceeds to make more loans. Subprime mortgages, no documentation loans, adjustable rate mortgages with teaser rates, all of it built on the assumption that housing prices would keep rising. By 2006, you could get a $500,000 mortgage with no job, no income verification, and no down payment. The credit expansion had severed any connection to the borrower's ability to repay. It was pure speculation, backed by nothing but the belief that prices would rise forever. When housing prices peaked and started falling in 2007, the entire structure collapsed. Borrowers defaulted. Securities backed by those mortgages became worthless. Banks holding those securities faced insolvency, and the global financial system froze. This is the first trigger. Credit expands beyond what the real economy can support. It happens because financial institutions profit from lending. The more they lend, the more they earn in fees and interest, regardless of whether the loans are sound. And it happens because regulators, policymakers, and the public believe that credit expansion equals growth. More lending means more activity, more jobs, more prosperity, until it doesn't, until the loans can't be repaid, until the assets purchased with borrowed money lose value. And then the system that looked so strong, so innovative, so modern, reveals itself to be built on air. The second trigger follows immediately. Asset prices inflate into bubbles that disconnect from underlying value. This isn't just high prices, it's prices that can only be justified by the assumption that someone else will pay even more tomorrow. Speculation replaces investment. By 1872, railroad stocks were trading at multiples that assumed every railroad would be profitable, that every mile of track would generate revenue, that the entire industry would grow forever. None of that was true. The stocks were priced for perfection in a world where most railroads were marginal or outright failures. But investors kept buying because prices kept rising. The fundamentals didn't matter. Momentum mattered. By 1928, stock valuations had reached levels never seen in American history. The price-to-earnings ratio of the overall market was above 30. Companies with no earnings were trading at extraordinary prices because investors believed they'd have earnings soon, or because they believed they could sell to someone else at a higher price. It was speculation layered on speculation, and the entire market had become a bubble, sustained not by value but by belief. By 2005, housing prices in major American cities had doubled or tripled in less than a decade. In some markets, homes that sold for $200,000 in 2000 were selling for $600,000 in 2006. Incomes hadn't tripled, rents hadn't tripled. The utility of the house, the value it provided as shelter, hadn't changed. The price inflation was pure bubble, driven by speculation and the availability of credit. People bought homes not to live in them, but to sell them a year later at a profit. Flipping became an industry. Television shows celebrated it, and everyone believed that housing prices could only go up. This is what bubbles do. They create their own logic. Prices rise, so people buy, expecting further rises. More buying pushes prices higher, which validates the belief that buying was smart. And anyone who questions it, anyone who points out that the prices make no sense, is dismissed as pessimistic, outdated, or ignorant. The bubble becomes consensus reality, until it isn't. Here's why this trigger is so dangerous. Bubbles don't just inflate prices, they reallocate resources. During the railroad bubble, capital that could have gone to productive industries went to building railroads that would never be profitable. During the 1920s stock bubble, money poured into speculative ventures instead of sustainable enterprises. During the housing bubble, construction boomed in areas where there was no real demand, creating entire neighborhoods of homes that would sit empty after the crash. The economy becomes distorted, too much capital in the wrong places. And when the bubble pops, all of that misallocated investment is revealed as waste. The houses that shouldn't have been built, the railroads that shouldn't have been financed, the companies that shouldn't have been valued so highly. It all collapses at once, and the real economy, the part that produces goods and services people actually need, is left weakened, smaller, unable to absorb the workers and capital that had been diverted into speculation. The third trigger is always there, humming in the background. Wealth and income concentrate in the hands of a narrow elite, while the middle and working classes lose purchasing power. This isn't about fairness or morality. It's about structure. When wealth concentrates, the economy becomes dependent on the spending and investment decisions of a small number of people, and that creates fragility. Before 1873, the wealth generated by industrialization flowed overwhelmingly to factory owners, railroad magnates, and financiers. Workers earned wages, but those wages didn't keep pace with productivity gains. The gap widened. By the early 1870s, a tiny fraction of Americans controlled the majority of financial assets. When those elites pulled back on spending or investment, the entire economy felt it. Before 1929, the concentration was even more extreme. The top 1% of Americans held nearly 40% of the nation's wealth. The bottom 90% held less than 20%. Consumer spending, which drives the majority of economic activity, was constrained because most people didn't have money to spend. The economy became dependent on the wealthy buying luxury goods and on speculative investment in the stock market. When both of those collapsed in 1929, there was no floor. The middle class couldn't fill the gap because they didn't have the income. Before 2008, the pattern had repeated. From 1980 to 2007, real wages for the median American worker stagnated. Productivity increased, corporate profits increased, but wages didn't. The wealth generated by growth flowed to the top. By 2007, the top 1% again held nearly 40% of wealth. The middle class maintained living standards by borrowing, taking on mortgage debt, credit card debt, student loan, debt. But debt isn't income. It's deferred consumption, borrowed from the future. And when the debt couldn't be serviced, when housing prices fell and jobs disappeared, the consumer base collapsed. Here's why this trigger matters. Economies don't run on wealth, they run on spending. If wealth concentrates and doesn't circulate, demand weakens. Factories produce less because fewer people can afford to buy. Fewer goods produced means fewer jobs. Fewer jobs means even less demand. The cycle reinforces itself downward, and no amount of wealth at the top can substitute for broad-based purchasing power. A billionaire can only buy so many cars, so many meals, so much housing. The economy needs millions of people with moderate incomes spending consistently. When that disappears, the economy stalls. The fourth trigger is structural. The financial system becomes interconnected and opaque to the point where no one understands the full risk exposure. Institutions lend to each other, hold each other's assets, insure each other's bets, and the web becomes so complex that a failure in one place cascades everywhere. Before 1873, banks held railroad bonds as safe assets, but those banks also lent to each other and accepted each other's notes as payment. When the railroad bonds defaulted, the banks that held them faced losses. Those banks couldn't honor their commitments to other banks. And the trust that held the system together, the assumption that every bank's promise was good, evaporated. Banks refused to lend to each other. Credit froze. And businesses that depended on credit to operate, to pay workers, to buy materials, couldn't function. The panic spread not because every business was failing, but because the financial system had become so interconnected that one sector's failure paralyzed the whole. Before 1929, the interconnection was different, but just as dangerous. Brokers lent to investors on margin, but brokers themselves borrowed from banks to fund those loans. Banks borrowed from each other and from the Federal Reserve. Investment trusts, the precursors to mutual funds, borrowed to buy stocks, using the stocks themselves as collateral. It was leverage on leverage backed by confidence. When stock prices fell, the brokers faced margin calls from banks. The brokers issued margin calls to investors. The investors couldn't pay and defaulted. The brokers couldn't pay the banks. The banks couldn't pay each other. And the entire structure, which had seemed so sophisticated and modern, collapsed in weeks. No one had understood the full extent of the interconnection. No regulator had a map of who owed what to whom. The system was opaque even to the people operating it. Before 2008, the complexity had reached a new level. Banks originated mortgages and sold them to investment banks. Investment banks packaged the mortgages into securities and sold slices of those securities to pension funds, insurance companies, hedge funds, and other banks. Those buyers used the securities as collateral to borrow more money and buy more securities. Hedge funds bought credit default swaps, essentially insurance policies, on the securities from companies like AIG. AIG didn't have the capital to pay if the securities defaulted. But no one checked, because the system assumed housing prices couldn't fall nationwide. When mortgages started defaulting in 2007, the securities lost value. Institutions holding those securities faced losses. They tried to sell, but there were no buyers. Prices collapsed. Institutions that had insured the securities, like AIG, faced claims they couldn't pay. Banks that had lent to those institutions faced losses. And the interconnection meant that every major financial institution in the world was exposed. The system froze. Banks stopped lending, not just to consumers but to each other, because no one knew which banks were solvent and which were insolvent. Trust disappeared. And without trust, a financial system can't operate. The system becomes so complex, so interconnected, so opaque, that risk is invisible until it's everywhere. And when the crisis hits, it doesn't stay contained. It spreads instantly through every connection, every loan, every security, until the entire system is paralyzed. No one designs it this way intentionally. It happens because every institution is optimizing for its own profit and its own risk, without seeing the systemic risk they're creating collectively. And regulators, even when they're trying, can't map the connections fast enough to stop the cascade. The fifth trigger is political and structural. Regulatory oversight weakens or is captured by the industries it's meant to supervise. This happens in every cycle. It's not about corrupt individuals, though sometimes those exist. It's about institutional drift. Regulators are staffed by people from the industry. They share the industry's assumptions, and they're subject to political pressure to avoid actions that might slow growth or disrupt markets. Before 1873, banking regulation barely existed. Banks operated under state charters with minimal supervision. There was no central authority monitoring systemic risk, and when the railroad bonds started failing, there was no one with the authority or tools to intervene. The system collapsed because there was no system of oversight. Before 1929, regulation had improved slightly. The Federal Reserve existed and had some tools to manage credit, but the Fed was reluctant to act. Officials believed markets were self-correcting. They believed that speculation was a private matter and that intervening would be overreach. Even as margin lending reached absurd levels, even as stock prices disconnected from earnings, the Fed did nothing. The assumption was that the market knew best, and by the time it became clear the market didn't know best, it was too late. The regulatory mindset had been captured by the ideology of the era, the belief that finance was self-regulating and that government intervention was harmful. Before 2008, the regulatory failure was even more explicit. During the 1990s and early 2000s, financial deregulation became policy. The Glass-Steagall Act, which had separated commercial and investment banking since 1933, was repealed in 1999. Regulations on derivatives were blocked. The Securities and Exchange Commission reduced oversight of investment banks, and regulatory agencies were led by people who believed that markets were efficient, that innovation was always good, and that regulation stifled growth. When warnings were raised about subprime lending, about the housing bubble, about the risks in mortgage-backed securities, regulators dismissed them, not because they were corrupt, but because they genuinely believed the system was sound. The industry had convinced them, and the industry had convinced them because the regulators came from the industry, shared its assumptions, and planned to return to the industry after their government service. This is the fifth trigger. Oversight disappears at exactly the moment it's most needed. And it disappears not through conspiracy, but through institutional capture and ideological drift. The people who should be watching are either unable or unwilling to see the risk. And by the time the risk becomes undeniable, the collapse is already underway. The sixth trigger is monetary. Central banks attempting to manage growth or respond to political pressure. This floods the system with cheap money and enables all the other triggers. Low rates make borrowing easy. They encourage speculation. They push investors into riskier assets searching for returns. And they disguise underlying weakness in the economy. Before 1873, there was no central bank, but credit was still too easy. Banks overissued notes and overextended loans because there was no constraint. When the defaults came, the money supply contracted violently, and the economy collapsed into deflation. Before 1929, the Federal Reserve kept rates low through most of the 1920s. The economy was growing, but much of that growth was speculative. The Fed believed that as long as consumer prices weren't rising, inflation wasn't a problem. They ignored asset price inflation in the stock market. By the time they raised rates in 1928, trying to cool speculation, it was too late. The rate hikes helped trigger the crash, but the damage had been done. The bubble had been allowed to inflate for years. Before 2008, the Federal Reserve under Alan Greenspan and then Ben Bernanke kept rates at historic lows. After the dot-com crash in 2000, the Fed cut rates to 1% and held them there for years. The stated goal was to support recovery, but the effect was to enable the housing bubble. With rates so low, mortgages were cheap, borrowing exploded, housing prices soared, and the entire economy became dependent on rising home values and increasing consumer debt. When the Fed finally started raising rates in 2004, the housing market peaked and then collapsed. The cheap money had created the bubble, the rate hikes popped it, but the Fed never acknowledged that its own policy had been the fuel. Here's why this trigger is so consistent. Central banks face a political and structural dilemma. If they raise rates to cool speculation or prevent bubbles, they risk slowing growth and being blamed for recession. If they keep rates low to support growth, they enable bubbles and excessive leverage. The political pressure is always to keep rates low, keep growth going, keep asset prices rising, don't be the one who ends the party. And so central banks, again and again, err on the side of easy money. They tell themselves they're supporting the real economy. But what they're actually doing is inflating the financial economy, pumping cheap credit into a system that uses it for speculation rather than productive investment. And when the crash comes, the central bank acts surprised, as if the bubble appeared out of nowhere, as if their own policies had nothing to do with it. The seventh trigger is psychological and social. The public, encouraged by elites and the media, begins to believe that the old rules no longer apply. This time is different. The economy has reached a new paradigm. Risk has been tamed, and anyone who doesn't participate will be left behind. This belief is what sustains the bubble in its final stages. Before 1873, the belief was that railroads had made distance irrelevant, that the entire continent would be connected, that every railroad investment would pay off because America's future was railroads. The skeptics were dismissed as old-fashioned. Before 1929, the belief was that the economy had entered a permanent plateau of prosperity. Technology, electrification, mass production, all of it meant that the business cycle had been defeated. Stocks would rise forever because American industry would grow forever. Economists wrote books proclaiming the end of depressions, and anyone who questioned the stock market's valuation was ignored. Before 2008, the belief was that financial engineering had distributed risk so effectively that systemic collapse was impossible. Housing prices might fluctuate locally, but they couldn't fall nationwide. Securitization had made the system safer. Diversification had eliminated danger. And anyone who worried about subprime lending or housing bubbles was dismissed as not understanding the new financial instruments. The phrase you heard everywhere was, "This time is different," but it never is. The mechanics change, the technology changes, the specific assets change, but the underlying dynamics, the 7 triggers, remain the same. Credit expands beyond fundamentals. Asset prices bubble, wealth concentrates. The system becomes interconnected and opaque. Regulation weakens. Central banks enable it, and the public believes the risk has disappeared. These 7 triggers don't guarantee collapse on a schedule. They're not a countdown timer, but when all 7 are present, when all 7 are active simultaneously, collapse becomes not just possible but likely. And the collapse, when it comes, is always worse than anyone expects because the triggers reinforce each other. Let me show you how they connect. Easy credit from central banks triggers 1 enables asset bubbles trigger 2. Bubbles concentrate wealth in the hands of speculators and financiers trigger 3. Concentrated wealth in finance increases the political power of financial elites, which weakens regulation trigger 5. Weak regulation allows the financial system to become more interconnected and complex trigger 4. Complexity hides risk, which makes the public confident trigger 7. And public confidence drives more speculation, more credit expansion, more bubbles. It's a cycle. Each trigger enables the next. And once the cycle is in motion, it's almost impossible to stop, because stopping it requires actions that are politically unpopular, economically painful, and ideologically unacceptable to the elites who benefit from the cycle continuing. Now let me bring this into the present. Look at the years since 2008. Credit has been cheaper than at any point in history. The Federal Reserve held rates near zero for 7 years, then raised them slightly, then cut them again, then raised them again in 2022 and 2023. But for most of the period since 2008, borrowing has been nearly free. Asset prices have inflated dramatically. Stock markets reached all-time highs. Real estate in major cities surged. Cryptocurrency created a speculative mania. Private equity borrowed trillions to buy companies at inflated valuations. The bubbles are everywhere, in different assets than 1929 or 2008, but bubbles nonetheless. Wealth concentration has reached levels not seen since 1929. The top 1% of Americans hold more wealth than the entire middle class. The gains from growth since 2008 have flowed overwhelmingly to the top. The middle class has seen minimal wage growth, and much of their wealth is tied up in home values and retirement accounts, both of which are vulnerable to market crashes. The financial system has become more interconnected, not less. The big banks are bigger than they were before 2008. Shadow banking, private equity, hedge funds, all have grown, and the instruments connecting them, derivatives, repos, collateralized loan obligations. No regulator has a full map of the system. Regulation strengthened briefly after 2008, but has been eroding. Political pressure to reduce oversight has been constant. Agencies are understaffed, and the ideology that markets self-regulate has returned. Officials talk about innovation and growth. They avoid talking about systemic risk. Central banks have enabled all of it. Zero interest rate policy, quantitative easing, bond buying programs, all of it pumped money into the financial system. And when inflation finally forced the Federal Reserve to raise rates in 2022, markets shuddered. Banks began to fail. Regional banks collapsed in 2023 because they'd loaded up on low-yield bonds during the zero-rate era. And when rates rose, those bonds lost value. The cycle is visible, and the public belief? It's there too. For years, the narrative was that central banks had figured out how to manage the economy, that downturns would be shallow, that the Fed had tools to prevent crises. Even now, after the inflation surge of 2021 and 2022, even after the rate hikes and the banking stress, the dominant belief is that the system is resilient, that we learned from 2008, that the risks are managed. This time is different, but it isn't. The 7 triggers are active right now. Not all at the same level as 1929 or 2008, but all present, all functioning, all interacting. And history says that when all 7 triggers are active, collapse follows. Not tomorrow, not on a schedule, but eventually. And when it comes, it will follow the same pattern. Credit contracts, asset prices fall, wealth evaporates, the interconnected system freezes, trust disappears, and the economy enters a downturn that's deeper and longer than anyone expected. Here's what this means for you. You can't predict the exact timing. No one can. The system can remain unstable for years. Bubbles can inflate longer than seems possible. But you can see the triggers. You can recognize them in real time. And you can understand that the longer all 7 remain active, the more severe the eventual correction will be. This isn't about fear. It's about pattern recognition. The same triggers have preceded every major collapse in American history. They're not hidden, they're documented, they're measurable, and they're active right now. The elites who benefit from the cycle, the financial institutions, the asset managers, the private equity firms, they understand this, they know the triggers, they watch them, and they position themselves to profit from the collapse when it comes, buying assets at distressed prices, consolidating power, emerging stronger while everyone else is weaker. You're not going to hear this on the news. You're not going to read it in the mainstream financial press. Because acknowledging the 7 triggers means acknowledging that the system is structurally unstable, that it's designed to produce crises, and that the people in charge either don't understand that or don't care because they benefit from it. So the narrative you'll hear is that everything is fine, that concerns are overblown, that the economy is resilient, that this time really is different, until it isn't. Until the triggers activate fully, until the credit stops, until the bubbles pop, until the interconnected system seizes. And then the same people who told you everything was fine will act shocked, will claim no one could have seen it coming, and will demand bailouts to save the system. You'll have seen the 7 triggers, you'll have understood the pattern, and you'll recognize that it wasn't a surprise. It was history repeating, the same script, the same sequence, the same result. The panic of 1873 followed the 7 triggers. The crash of 1929 followed the 7 triggers. The stagflation of the 1970s followed them. The 2008 collapse followed them. And the next crisis, whenever it comes, will follow them too. Because the triggers aren't external shocks. They're not caused by wars or pandemics or political events, though those can accelerate the process. The triggers are internal to the system itself. They're how the American economy operates. Expand credit, inflate assets, concentrate wealth, interconnect the financial system, weaken oversight, keep money cheap, and convince everyone that risk has disappeared. That's the cycle. And it repeats because the people who profit from it have no incentive to stop it. They profit on the way up during the bubble, and they profit on the way down during the collapse, buying assets cheap and consolidating control. The people who suffer are the ones in the middle, the workers, the savers, the small business owners, the ones who believed the system was stable and played by the rules. If you want to understand how power actually works, if you want to see the structure beneath the surface, you have to recognize the 7 triggers. They're not conspiracy, they're pattern, they're documented history, repeating for 150 years, and they're active right now. Watch for them, track them, and understand that when all 7 are flashing red, the collapse is not a possibility. It's a probability. Not certain, but likely. And the longer the triggers remain active, the more severe the collapse will be when it finally comes. Subscribe if you want to keep tracking these patterns, if you want to understand the structure of economic history, the cycles of collapse, and the mechanisms the elites use to navigate them. Because they're not going to teach you this. They're going to teach you that collapses are unpredictable, that they're caused by external shocks, that no one could have seen them coming. But that's not true. The triggers are there. They've always been there. And once you see them, you can't unsee them. The 7 hidden triggers behind every major American collapse: credit expansion, asset bubbles, wealth concentration, financial interconnection, regulatory capture, monetary excess, and the belief that this time is different. Recognize them, track them, and understand that the system isn't broken. It's working exactly as it was built to work, and the people who built it knew what they were doing.